Market is broken. What I'm saying is there's not enough money that is being dedicated to investing, trying to identify undervalued companies and reward companies with new capital that have good opportunities for growth, and to punish companies that don't have such good situations, because the professional industry of figuring this stuff out has largely been eradicated.
Is value investing dead, and can you still generate returns in the market by buying stocks which are trading below their fair value? This video, you guys are going to find out. I'm going to dive into the academic studies, the investment management hedge fund reports, and much, much more to really get to the deep heart of this question. Should you be buying value stocks, or should you just be chasing momentum and even growth? Now, this goes to the question of what is intrinsic value. Now, Buffett has a historic talk which really talks through this concept.
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
Okay, so according to Buffett, really what we're looking for is to assess a stock, which is a portion of a company, and we want to analyze that business and say, how much cash flow do we expect that business to produce over its lifetime? We then discount that cash flow back to at today's discount rate, which is really the opportunity cost. For example, if you put that money into US Treasury bonds or a high interest savings account, what is the risk-free rate that you're giving up in order to take a risk on this business with an expected return? Now, some people will have a minimum, what they call hurdle rate, or a minimum investment return that they are looking for in order to actually gain conviction to put money into that particular investment. Now, the philosophy sounds super simple. It seems to make a lot of sense. Buy things for less than they are worth, and over time, Mr. Market will actually realize the value of the company and then correct the price, and therefore you generate a capital appreciation and an uplift in that stock price, and maybe some dividends along the way if it's a dividend stock. Now, this sounds simple, but some of the greatest hedge fund managers, such as David Einhorn, who's a billionaire and runs Greenlight Capital, believe the current market is broken. Okay, so let's start with Benjamin Graham, the father of value investing. Now, this guy was the mentor of Buffett. So think about him as the legend that taught the legend. Now, his strategy was interesting. He used to buy companies trading at less than 66% of their net current asset value. So he was often buying $1 worth of liquid assets for 50 to 60 cents. Now, he did emphasize wide diversification to manage risk, but he reportedly earned over his 30-year investment career 20% annually, which is pretty amazing, and this is kind of the level that Buffett earns these days. Now, there was also an independent study done between 1970 and 1983, and this found that net stocks, these cigar butt investing, returned 29.4% per year. Now, of course, Benjamin Graham always looked for a margin of safety, so he would value the company, value its assets, and then aim to buy significantly below that intrinsic value. Now, what's the problem with this investing style? Well, it worked back then, which is great. But during Benjamin Graham's heyday, he was really focused during the time of a Great Depression, during the time when there was also less competition. So this style of what Buffett and I believe Monger often called cigar butt investing, looking for really the cheapest, really sometimes quite terrible businesses to buy and then maybe get an uplift on the asset value. It worked during certain scenarios and during certain time periods, but even Buffett discovered during his career that often it needed some improvement in this strategy. Okay, now the evolution of Buffett's investing style to focus more on quality companies and not just the cheapest and sometimes terrible companies This was often said to be cited and influenced by his good friend, the great Charlie Munger. Now, a great quote summarizes up this strategy. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So really this says, rather than looking for a super cheap business and then saying, okay, is it a good company? Start with looking for a great company, which there are many to identify, and then aim to buy it below its intrinsic value. Now, a prime example is Buffett's purchase of See's Candies in 1972. This is often said to be a wonderful business at a fair price. So Buffett paid $25 million for See's Candies. Now, this is interesting because he paid $25 million, but its book value was $8 million. Now, it had an annual pre-tax profit of $4 million. However, what Buffett realized is it had exceptionally high return on invested capital, ROIC, with minimal reinvestment required. He also realized the power of brand loyalty and also pricing power. He realized that this company could continue to raise its prices due to its strong brand, and people would still buy the candy. Now, in the words of Charlie Munger, he called it the prototype of a great business. And Buffett said, we learned the value of paying up for a great business in one of his annual shareholder letters. Okay, so let's dive into more data on value investing and its historic performance. Okay, now a really great case study to use was Buffett's 1984 speech on the super investors of Graham and Doddsville. Now, originally, this speech was done to challenge what's called the efficient market hypothesis, which basically says that any new information will automatically be priced into the stock market instantly, therefore making buying value actually not even possible. Now, Buffett obviously disputed this strategy, and not just from his own performance, but he gave a really great example of an intellectual town called Graham and Doddsville. Now, in this town lived some legendary investors, and of course, this includes Walter Schloss, Tom Knapp, the Buffett Partnership, the Sequoia Fund with Bill Ruan, Charlie Munger, Rick Guerin, Stan Perlmutter. Now, these people lived in this imaginary town. They all followed a Graham-style investing strategy. Now, here we can see their incredible returns. Walter Schloss, 21.3%, Tom, 20%, Buffett, 29.5%, etc., 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 all beating the S&P 500 with significant outperformance. Now, this was really Buffett's two fingers or one finger to the efficient market hypothesis in order to say, look, value investing works and it's a great strategy. Here's its track record. But value investing has not always been a successful strategy. So here are some data. Post the global financial crisis in 2008-2009, the market had a distinct and prolonged shift in market leadership, challenging the long-term narrative of value stock outperformance. For example, as a simple measure of value and growth, the Russell 1000 Growth Index outperformed the Russell 1000 Value Index by a cumulative margin exceeding 114%. So over 10 years leading up to early 2021, US growth stocks beat the US value stocks by an average of 7.8% per year. If you were a value investor between, say, 2011 and 2021, you would have been in terrible shape. You would have not seen a great return. You would have been holding for a decade, and while your growth friends are all making serious returns. Now, there are some factors which many economists point to of why this occurred. Now, the first is the technology revolution. Many of these returns driven by many of these companies has been driven by what were previously called the FANG stocks, or now the Magnificent Seven. Huge tech stocks are really driving the majority of the returns in the S&P 500. Now, we also had a low interest environment during that period. Now, this is post the global financial crisis, and this disproportionately benefited growth stocks. If your risk-free rate is, say, 1% or 0.5%, this means, okay, there's no point putting my money into the bank and earning 1% interest. I might as well put it into a more risky asset. And this goes back to the principle of Tina, there is no other alternative. This is why in 2020, and I'm sure when you guys were watching this channel, we saw a number of growth stocks, SPACs, IPOs, many stocks popping by 20, 30, 40, 50% in a single day, sometimes 100, 200%. Now, that was not a normal environment. Don't get me wrong, it was fun. It was great while the gains lasted. But post 2021, as interest rates started to rise, we saw a huge shift from growth back into value. Now, the queen of growth, Cathy Wood, really is the epitome of what happened during that period. So in 2020, she generated a staggering 152% return, and she was seen as a stock market god or goddess. But then as 2021 came, her fund dropped by 23%. 2022, it dropped by 66.99%. So unless you are a lucky trader or investor or very skilled in terms of you invested into her fund or her similar growth stocks in 2020, you exited early 2021, and then maybe you got back in end of 2022, then you would have benefited. So it's if you can dance in and out of the market, as Buffett often says he's not very good at, if you can do that, then you can benefit from both the growth and value cyclical shifts, which seems to be how the market works in terms of favoring value or growth. Okay, so let's go back to the core question. Is value investing dead? I would personally say no, because if we go back to the words of Charlie Monger,
all intelligent investment is value investment.
All intelligent investing is value investing, because why would you want to pay more for something than it's worth? Also, Monger often says that growth is a component of value, and even the growth investor Ron Barron often says value is a component of growth. So it's all part of the same pie. If we are valuing a company, we are also aiming to forecast its growth in cash flows. Now, although that's harder to forecast, so people may take a more cautious route, it's really all part of the same style. Now, of course, there are some differences in terms of risk profile, in terms of volatility. It's true, looking at historic data, investing in value stocks does generate alpha or market returns. However, there is a major caveat to this, and that is the fact that there can be prolonged periods where value stocks are not actually meeting what one will consider their intrinsic value. Now, this can be a tough time. It can last 5 years, even 10 years. And that can be the time that really does test a true value investor. Are you committed to that strategy? Okay, so what's the best strategy for you? Well, this all depends on your personal preference, your investing style, and also your personality. Personally, I like to think of myself as a modern value investor. Yes, I will look for things trading below fair value, but I'll also take into account growth a lot. I'll look at growth potential, I'll look at the tech, I'll look at the founder, I'll look at the moats, I'll look at the competitive advantage. So I'll look at it as a full encompassing strategy. Value is a component, but it's not everything, because there are value traps where a company can look super cheap. You buy it and it just goes cheaper. So really what you have to look for with value is, here's a company, it's trading below fair value on some temporary bad news. Now, you know that this is not going to impact the fundamentals, and honestly, you're expecting a recovery to come. That is usually the best time to buy during those periods, and that is how you can generate serious returns in the market. Now, if you found this video helpful, I would recommend subscribing to the channel, clicking the notification bell, give it a thumbs up if you did find it helpful, and also check out our links in the bio below on the different investment platforms and even a valuation platform that we have links to right now. With that being said, from the bottom of my heart, I wish you guys a fantastic rest of your day, incredible luck in the market, and I'll see you next time.